Today, we're diving into a topic that's been gaining a lot of traction in the world of real estate and finance: home equity agreements, or HEA. You might have heard the term, but what exactly is it? Is it a loan? Is it something else entirely? Let's break it all down in a simple, easy-to-understand way. So, what is a home equity agreement? Think of it as a partnership. It's a financial tool that allows you, the homeowner, to get cash from the equity you've built up in your home without taking on new debt. This is the key difference. Unlike a home equity loan or a HELOC, an HEA isn't a loan. There are no monthly payments and no interest charges. Here's how it works. A financial company gives you a lump sum of cash today. In exchange, they get a share of your home's future appreciation. You're basically selling them a small piece of your home's potential future value. You get the money you need now, and the company shares in the profit or loss when you sell your home down the road. Let's use a simple example. Imagine your home is currently worth $500,000 and you have $200,000 in equity. You might enter into an HR for $50,000 in cash. In return, the company might receive, say, a 20% share of your home's future change in value. You get the $50,000, no strings attached, no monthly bill to worry about. So, where's the catch? It's not really a catch, but a trade-off. The agreement has a set term, usually around 10 to 30 years. At the end of that term, or whenever you decide to sell your house before then, you have to settle the agreement. This means you'll pay back the original $50,000, plus that agreed-upon 20% of the appreciation. Let's say in 10 years, your home's value has increased by $100,000. You'd owe the company their 20% share of that increase, which is $20,000, on top of the original $50,000. So you'd pay back a total of $70,000. But what if your home value goes down? This is where HEA can be different from traditional loans. If your home's value drops, the company shares in that loss as well. Their share of the value decreases, so you could end up paying back less than the original amount you received. It's a shared risk, shared read model. Who is an HEA good for? It can be a great option for people who need cash but do want the burden of another monthly payment. Maybe you want to pay off high-interest debt, fund a business, or pay for a major expense like a renovation or college tuition. If you have a lot of equity but your income makes it tough to qualify for a traditional loan, an HEA could be a viable alternative. However, it's not for everyone. The biggest consideration is that you're giving up a portion of your home's future equity. If you live in a booming real estate market, that could be a significant amount of money. You're trading potential future gains for immediate cash. That's why it's crucial to read the fine print, understand all the terms, fees, and the exact percentage of appreciation you're sharing. To sum it up, a home equity agreement is a non-debt way to access your home's equity. You get cash now with no monthly payments, and in return, an investment company gets a share in your home's future value. It's a partnership. As with any major financial decision, do your research, compare different companies, and maybe even consult a financial advisor to see if it aligns with your long-term goals. I hope this explanation cleared things up. Thank you for watching.